Welcome back to the channel, everyone. Today we are diving into something deeper than charts, numbers, or stock picks. Because the truth is, most investors don't lose money because of bad investments. They lose money because of bad decisions. And those decisions come from something hidden inside all of us, our psychology. So in today's video, we're breaking down why your brain is programmed to sabotage your financial decisions, the most dangerous investing biases, real examples, and how to override these mental traps to make smarter investment decisions. So if you've ever bought too late, sold too early, panicked, overtraded, or followed the crowd, stay tuned, because this video might save you thousands of dollars in the future. Section 1. Why investing psychology matters. Before we dive into the biases, let's answer the big question. Why does psychology matter more than math in investing? Simple. Investing isn't just a numbers game. It's a behavior game. Two people can have the same portfolio, but completely different results depending on how they react to fear, greed, uncertainty, and noise. That's why Warren Buffett famously said, "The most important quality for an investor is temperament, not intellect." Your IQ won't save you from emotional decisions, but understanding your psychology will. Section 2. A behavioral bias. Let's start with one of the biggest troublemakers, confirmation bias. This is when you search for information that confirms what you already believe and ignore everything that contradicts it. Example, you decide company X is the next big thing. So what do? You look for bullish articles, positive news, and YouTubers who agree with you. If someone posts criticism, you think they don't get it. Your brain basically says, "I've made my mind up. Don't confuse me with facts." Why this is dangerous? You become blind to risk. You only see what you want to see. How to avoid it? Actively search for reasons not to buy. Follow people who disagree with you. Ask, what evidence would change my mind? Smart investors consider both sides before making a move. Next up is something we all feel, loss aversion. Your brain hates losing more than it enjoys winning. Psychologists say losing $100 feels twice as painful as gaining $100 feels good. Example, you buy a stock at $100. It drops to $70. You tell yourself, "I'll sell when it goes back to $100. But that's just your brain trying to avoid the emotional pain of taking a loss. What happens? You hold a losing stock longer than you should, and sometimes it drops even more. How to avoid it? Set exit rules before buying. Review your portfolio without looking at the purchase price. Focus on long-term value, not short-term pain. 3. Overconfidence bias. Everyone thinks they're a better than average investor, but that's statistically impossible. Overconfidence makes you think, "I can time the market. I know what's going to happen. This time is different. I'll get out before the crash." The result, overtrading, taking unnecessary risks, chasing trends, ignoring warning signs. Real talk, if professional hedge funds with research teams struggle to beat the market, why would a solo investor with a phone and TikTok clips do better? How to avoid it? Don't mistake luck for skill. Keep a trading journal. Diversify instead of betting everything on your gut feeling. For herd mentality, humans are wired to follow the crowd. In investing, this leads to panics, bubbles, and bad timing. Example, everyone is buying a trending stock. You don't want to miss out, so you buy too late. When it crashes, everyone sells, and so do you. Herd behavior creates two big emotional traps: FOMO, fear of missing out, fear of being wrong alone. How to avoid it? Ask, if no one else was talking about this, would I still invest? Avoid making decisions based on social media hype. Remember, the crowd is often wrong at extremes. 5. Anchoring bias. This is when your brain fixates on the first piece of information and bases all future decisions around it. Example, a stock used to be $200. Now it's $100. You think, it's cheap. It must go back up. But maybe the company's fundamentals changed. Maybe it will never see $200 again. Anchoring makes you cling to past prices, old predictions, and previous highs. How to avoid it? Focus on current value, not historical price. Ask, would I buy this today if I didn't know its past? 6. Recency bias. Your brain assumes that whatever is happening right now will continue happening forever. If the market is going up, people think, this will never stop. If the market is crashing, people think, it's over. Everything is doomed. Recency bias leads to buying at the top, selling at the bottom, panicking during short-term dips. Avoid it by zooming out, studying long-term market cycles, reminding yourself that markets rise and fall in waves. 7. Sunk cost fallacy. This is when you stay in a bad investment because you've already put so much into it. Example, you invested $5,000 in a project that clearly isn't working. But you tell yourself, I can't stop now. I've invested too much. That's like saying, I ate half a rotten sandwich. Might as well finish it. How to avoid it? Don't let past decisions control future ones. Evaluate investments based on today, not what you already spent. Be willing to cut losses when the thesis is broken. 8. Emotional investing. Fear and greed are the two strongest forces in the market. Fear causes panic selling, avoiding investments altogether, doubting your long-term plan. Greed causes over-leveraging, chasing high-risk trades, wanting quick profits. But if you invest emotionally, you'll always react too late. How to avoid it? Create a written investment plan. Automate contributions. Avoid checking your portfolio daily. Practice patience. Section 3. Building better investing habits. Now that we know the traps, let's talk solutions. Here are practical steps to build a psychology that supports long-term success. 1. Have a clear strategy. Long-term investing, value investing, dollar cost averaging, index funds. Know your approach before you start. 2. Set rules before you invest. When to buy, when to sell, why you're buying, what would make you exit. If you decide rules before emotions kick in, you make better choices. 3. Limit information overload. Too much news creates anxiety. Too much hype creates FOMO. Curate your information sources. 4. Accept that you will be wrong sometimes. Even the best investors are wrong a lot, but they survive because they manage risk and emotions. 5. Diversify. A single mistake can't destroy you if you're diversified. 6. And think long-term. True wealth is built through decades, not days. Final message: investing isn't just about what's happening in the market. It's about what's happening in your mind. If you can master your psychology, your biases, your fears, your habits, you'll outperform 90% of investors who rely only on predictions, news, and luck. So take control of your behavior, understand your biases, and build an investment strategy that protects you from your own brain. If you enjoyed this video and want more content on investing, money psychology, and financial freedom, make sure to like, subscribe, comment which bias you struggle with the most. Thanks for watching, and remember, master your mind and you'll master your money. See you in the next video.